Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Satellogic.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And just real quick before we get into it, you can check out the VIP Algos link below in the description. It's a really solid tool for staying ahead of the market, finding those early signals.
Yeah, absolutely. Definitely check that out. So to kick things off today, I want you to imagine something. Picture trying to track a whole fleet of naval ships, right? And they're moving through a really high-tension area like the Middle East.
Okay, yeah.
But the map you're looking at is like 24 hours old. I mean, in modern geopolitics or even just global supply chain logistics, a day-old photo might as well be an ancient historical artifact.
Oh, totally, because the landscape is just moving constantly.
Exactly.
And that's really the wealth-building context we're diving into today. The demand has entirely shifted, away from just getting a nice high-resolution picture from space to needing a live, continuously updating video feed of the Earth.
A live feed. That is wild to think about.
Yeah, it's a fundamental rewiring of how global intelligence actually works. Like, the whole industry is moving from occasional aerial surveillance to this new era of persistent global intelligence. And the implications there, whether it's for global security, tracking commodities, or corporate logistics, they're just staggering.
You're not reacting to yesterday's news anymore.
Right, exactly. You're reacting to what is happening right this second.
Which brings us to the stock we're analyzing today, Satellogic. The ticker symbol is SATL. They're a space infrastructure company sitting right at the center of this massive transition.
Yeah, with a market cap of around $566 million right now.
Right, so they're relatively small, but they are right in the thick of it. And whether you're, heavily invested in the aerospace sector already or you're just kind of fascinated by the sheer scale of geospatial intelligence, we're going to break down how global conflict, artificial intelligence, and literal orbital mechanics are all just crashing together in this one highly volatile stock.
It really is a fascinating setup, because to grasp the stakes here, you have to look at the incredibly complex corporate pivot that Satellogic is attempting. Like, they're not satisfied with just being a hardware operator.
And by hardware operator, you mean?
I mean, a company that just builds a satellite, launches it, and sells the raw photos. That's the old model. Satellogic is trying to transform into this highly scalable data and AI ecosystem. If they pull that off, they stop being a traditional industrial heavy metal company and they become a tech platform, one that basically redefines how humanity observes its own planet.
Okay, let's unpack this for a second. Because before we can even touch the stock's crazy price swings and the technicals, we need to look at their fundamentals, right? Like under the hood.
That's a financial engine.
Exactly. We have to understand how building this platform in orbit actually generates revenue, and currently how it just burns through a massive amount of cash.
And the underlying mechanics are really interesting. So they operate their own proprietary constellation of Earth observation satellites. And the sheer number of satellites they have up there is what allows them to provide that persistent global intelligence, or PGI.
Because they can just keep circling back to the same spot.
Right. They can revisit the exact same location on Earth multiple times a single day.
Which is a huge advantage.
Yeah.
And looking at the numbers, the demand for that revisit rate is very real. Their trailing 12-month revenue is up over 25.6%. But the metric that immediately grabs your attention, and it's wild, is the gross margin. It sits at a staggering 75.08%.
Yeah, a 75% gross margin is just a total anomaly in the aerospace sector. You normally only see that kind of profitability on like a core product for a software as a service business.
Not a company blasting actual rockets into the exosphere.
No, exactly. Not heavy machinery and rocket fuel.
Let me throw an analogy out there just to make sense of that number for everyone listening. Think about their business model, like building a massive toll highway, right? Or maybe rolling out a national cellular network.
Okay, I like that.
The upfront capital you need to pave hundreds of miles of highway, or build all those toll plazas, or in Satellogic's case, to engineer the satellite, pay for a rocket payload, manage the telemetry that costs is just astronomical. It bleeds cash on the front end.
Massive cash burn.
Right. But once that satellite is operational and in orbit, the highway is built. Adding a new customer or selling that exact same data stream to a second, third, or 50th defense contractor costs practically nothing.
That's the key right there. The marginal cost of delivering that data effectively approaches zero, because once the physical asset is flying, making another copy of the data requires almost no extra capital. And that dynamic, that operating leverage, is literally the only reason the market tolerates the other side of their balance sheet, which is, frankly, incredibly ugly.
It's so ugly.
Yeah. While the gross margin is 75%, the net margin is an abysmal negative 443%.
Minus 443%. I mean, let that sink in. That means for every single dollar they bring in, they're spending over $5 just to keep the lights on and the satellites flying.
Yeah.
And their earnings per share, the EPS, is sitting at a negative 64 cents.
And all that cash burn is entirely driven by the colossal R&D they need, plus just the ongoing operating expenses of maintaining a fleet of spacecraft in low Earth orbit. I mean, it's a hostile environment. Satellites degrade.
They need software updates. They eventually break down and
Right.
need replacing.
Exactly. But the market hasn't abandoned them. Like, they obviously have a negative price-to-earnings ratio, but they actually command a price-to-sales ratio of over 27.
Wow, so that is a heavy premium valuation.
Very heavy.
Investors are looking at this company that is just bleeding cash.
Yeah.
And they're still willing to pay $27 today for every single dollar of sales the company makes.
Right. And they're paying that premium purely for the potential of that future operating leverage we talked about. Institutional investors are basically betting that once this constellation hits a critical mass, the top-line revenue will just scale exponentially, while those massive fixed costs finally flatten out.
So they're aggressively taking all that cash they're burning and pouring it back into what they call, and I love this corporate term, an agentic intelligence ecosystem with on-satellite processing.
Yeah, it's a mouthful.
It sounds like heavy jargon, but here is where it gets really interesting, because the mechanism behind that phrase is actually their entire competitive moat. It isn't just about taking a crisp photo from space and emailing it to a client.
Because sending raw data is actually a huge burden for the person receiving it. Unstructured geospatial data is so heavy, it takes massive bandwidth to download, and then you just have this terabyte of pixels that someone has to actually analyze.
Right, like if you hand a defense general or a logistics manager thousands of satellite photos of a port and say, here's the data you paid for, you haven't solved anything for them. You've literally given them homework.
Exactly. Now they have to go hire a whole team of analysts to sit there with magnifying glasses, counting shipping containers, or measuring oil tank shadows one by one. It's wildly inefficient.
And that bottleneck is why Satellogic's AI pivot is the most crucial part of this story. They realized raw photos are just a commodity, but actionable answers, those are invaluable. So they stopped just selling the pictures and started partnering with specialized AI analytics firms.
Right. They brought in a company called SpaceNow for their commercial markets, and then another firm called SynMax to focus exclusively on defense customers.
And the way these AI firms interact with the data is where that agentic part comes in. The AI acts as an agent. It doesn't just read the data, it actively interprets it. So if a client wants to know how much oil is leaving a specific port, the AI is trained to automatically count the vessels, measure how low they sit in the water to gauge the weight, and just instantly deliver a report.
So the client isn't buying a picture of a boat anymore. They're buying a push notification on their phone that says, hey, oil shipments from Port X are down 10% today.
That is so much more valuable.
It is. That fusion of raw geospatial data with a really advanced AI layer creates this incredibly sticky product. Because once a global shipping company or, an intelligence agency integrates that instant AI insight into their daily dashboard, ripping that subscription out becomes basically impossible for their operations.
And connecting this to the bigger macro picture, we really have to look at the geopolitical catalyst impartially here, because global instability is the primary driver forcing allied governments and NATO to urgently increase their spending on this persistent global intelligence.
Yeah, the whole nature of conflict and supply chain security has totally shifted. Just look at the reliance on satellite imagery in the Russo-Ukrainian war as a prime example. The conflict has required this unprecedented level of real-time monitoring from both the nations involved and the international community.
We're talking about tracking troops massing in remote forests.
Right.
Or monitoring naval fleets in the Black Sea.
Exactly. Or assessing immediate damage from strikes on energy grids and oil depots. It's nonstop.
And at the same time, you have the ongoing tensions in the Middle East, especially regarding the U.S. and Iran, creating this massive baseline demand for persistent monitoring. The defense sector needs continuous eyes on strategic choke points, like the Strait of Hormuz.
Yeah, they have to track commercial maritime traffic, watch regional military bases, look for mobile missile platforms. The geopolitical reality is that the demand for decision-ready, instantaneous intelligence is at a historical peak.
Yeah. It's basically the ultimate high ground advantage. But, and this is where it gets tricky, the disconnect investors have to grapple with is how all that intense real-world demand actually translates or fails to translate into the stock's technical performance and market sentiment.
Because looking at the stock chart for SATL, I mean, you need a strong stomach.
It is a complete roller coaster. Let's look at the technicals. The stock is currently trading right around $3.82. It had a nice pop of about 7% on the day we're analyzing. But the volatility is wild. The 52-week high was all the way up at $12.
And the 52-week low was $1.25.
So it's down over 68% from its absolute highs.
But simultaneously, it's up over 104% year to date. You really rarely see that kind of whiplash outside of like biotech or super speculative tech stocks.
And if you zoom in on the more recent time frame, they had this brutal 13-week pullback. The stock dropped nearly 45% over that period. I mean, for someone who bought in at the top of that recent run, watching half your investment evaporate in 3 months? Terrifying.
Oh, absolutely brutal. But, the way technical analysts interpret that specific chart structure actually tells a slightly different story. Because in the context of the stock doubling over the course of the year, a 45% pullback is often seen as a classic higher-low consolidation phase.
Break that down. Explain the mechanics of a higher low for anyone who isn't, staring at stock charts all day.
Sure, so think of the stock price kind of like a staircase. The stock took a massive, explosive leap up several steps based on momentum and good news. But eventually, the buyers get exhausted and the price starts to step back down.
Right, taking profits.
Exactly. But crucially, in a higher low consolidation, the price stops falling well before it hits the original ground floor. The new floor is significantly higher than the old one because new buyers are stepping in at a higher valuation, recognizing the fundamental progress the company made.
And the trading volume totally supports that theory. The 10-day average volume is sitting at about 4.8 million shares, but the current volume during this recent pullback is running at less than half of its 3-month average.
Which means the aggressive selling pressure is exhausting itself. The people who wanted to take their profits have mostly left, and the remaining shareholders are just holding tight.
But we also have to factor in the broader macroeconomic forces in the space sector, right? Because they heavily manipulated that pullback too. Analysts refer to it as the June gloom effect.
Yes. June gloom. It's a textbook example of how capital rotation hits these smaller cap companies.
We have to talk about the 800-pound gorilla in the room here, the massive SpaceX IPO. Because that event was just sucking capital from every corner of the market.
It really was. When a monolithic entity like SpaceX approaches the public markets, or even just does a massive funding round, institutional portfolio managers have to react. Say you run a massive mutual fund or an ETF dedicated to aerospace.
You have to own SpaceX.
You have to. You need to allocate a huge chunk of your capital to them because they're the undisputed industry leader. And to get that cash quickly, they mechanically sell off their positions in smaller, riskier space stocks.
Like Satellogic.
Exactly. So the stock price of SATL goes down, not because the company missed a deadline or lost a big contract, but simply because the big funds needed liquidity to buy into the giant. It acts like this gravitational black hole just starving the smaller caps of momentum.
Though recent flow data does show that space-related stocks are kind of bouncing back now as that capital organically redistributes across the sector. But I have to push back a little on the sentiment here.
Okay, lay it on me.
Because if you look at the insider activity filings, there is a data point that looks incredibly alarming at first glance. If the AI pivot is working so well, and if the defense demand is basically locked in, and that price drop was just a mechanical capital rotation, why did company insiders dump a net 9 million shares over the last 90 days?
Yeah, that's a lot of shares.
It is. When the people running the company are selling off millions of shares, it is really hard to sell a bullish narrative to the public.
That is exactly the question you should be asking. But it also reveals why looking at raw volume numbers without context is super dangerous. It is entirely true that the net volume is negative. 9 million shares left the hands of insiders.
Right.
But the actual sentiment is hidden in the transaction frequency, not the raw volume.
Walk me through the difference here.
Okay, so those 9 million shares were liquidated across only 9 separate sell transactions. So what you're looking at is a few early founders or high-level executives offloading massive, concentrated blocks of
Oh,
shares.
I see.
Yeah, it's incredibly common for liquidity events. Like an executive is buying real estate or paying massive tax bills or just trying to diversify a personal portfolio that is entirely locked up in one stock. One massive sale skews the entire volume metric.
So basically, a few people at the very top took a lot of money off the table.
Exactly. But during that exact same 90-day window, there were 18 separate buy transactions from insiders. You had double the number of individual directors, officers, and insiders reaching into their own personal bank accounts to buy the stock at these lower valuation levels.
Okay, yeah, that changes the picture entirely. The volume of selling represents just a few people cashing out, but the frequency of buying represents a much wider consensus among the staff that the stock is undervalued right now.
And the broader market algorithms actually track this exact nuance. There's a metric called the Insider Sentiment Score, which measures how the market is reacting to these internal filings. For SATL, the Insider Sentiment Score is sitting at a very strong 83.42 out of 100.
So the market largely ignores the few massive sell blocks and views those 18 individual buys as a massive vote of confidence from the people who actually see the daily operations.
Lot on.
So bringing it to the catalysts, what does this all mean for the timeline? Because the market is always forward-looking, and if you're evaluating this company, you need to know what specific events are going to either validate this highly optimistic thesis or trigger the bear case and send the stock plummeting back toward $1.
Well, the most immediate hurdle is the upcoming Q2 2026 earnings report. They just delivered their Q1 presentation on July 10th, so analysts are already modeling out the next quarter. And the entire focus of Wall Street right now is demanding proof of monetization.
Because it's very easy to issue a press release claiming you partnered with an AI firm.
Oh, absolutely. It is much harder to show a line item on a balance sheet proving that a government agency actually paid a premium for that AI analysis. They have to show that SpaceNo and SynMax are converting raw data into actual cash flow. And beyond just the raw earnings numbers, the catalyst everyone is really waiting for is the announcement of tangible, finalized Department of Defense contracts. As the SynMax defense collaboration matures, the market wants to see signed, multi-year agreements with global intelligence agencies.
And you really can't talk about catalysts in the space sector without touching on the rumor mill. We always treat speculation with caution, obviously, but the chatter around mergers and acquisitions is deafening right now.
It really is. I mean, Rocket Lab recently acquired Iridium Communications for $8 billion, which was a massive move to vertically integrate their operations.
And that acquisition kind of sets a precedent, doesn't it? A prime contractor realized it was way more efficient to just buy an existing communications network than to try and build one from scratch.
Exactly. And that sparks the conversation that a smaller, hyper-specialized data play like Satellogic could be the perfect acquisition target. I mean, they have a proprietary constellation already flying, they have the AI ecosystem integrated, and their market cap is only $566 million.
A massive defense contractor could literally just buy them with the cash they have on hand. They'd acquire all those capabilities overnight, rather than spending billions in R&D and waiting 5 years to launch their own satellites.
Right. In the defense and aerospace sector, consolidation is just the natural life cycle of smaller innovators. It is a highly plausible exit strategy for Satellogic, assuming they can prove their data ecosystem is irreplaceable.
We do have to give equal weight to the risks here, though. The bear case. Because as compelling as the AI moat and the defense contracts sound, that negative 443% net margin is just sitting there like a ticking time bomb.
It's the ultimate existential threat for them. They are burning cash at a prodigious rate just to keep the current constellation operational, let alone expanding it to reach that critical mass we talked about.
Right. And if the revenue growth stalls even slightly, or if the macro environment shifts, say, interest rates spike again, or there's another capital rotation event that starves the sector of liquidity, Satellogic is going to hit a severe liquidity wall. And we all know what happens when a cash-burning company runs out of runway.
Yeah, their primary survival mechanism becomes the secondary stock offering. They are forced to issue millions of new shares to the public just to raise emergency cash.
Which violently dilutes the current shareholders. It's the classic pizza analogy, right? You own a slice of the company, but to raise money, management takes that exact same pizza and slices it into 100 more pieces. Your slice suddenly represents just a tiny fraction of the value it held yesterday.
It's painful.
Very. So given that looming threat of massive dilution, is the 7 out of 10 bullish score we're seeing dangerously optimistic? Are they just in a desperate sprint to secure a massive government contract before the bank account hits zero?
I mean, it is an absolute sprint. That tension is the defining characteristic of investing in early-stage, capital-intensive infrastructure. The 7 out of 10 score is heavily weighting the size of the total addressable market and the sheer profitability of those 75% gross margins.
So if they make it, it's huge.
Yeah. If they can cross that break-even threshold without diluting the stock, the operating leverage will create staggering profitability. But if they stumble, the dilution will crush early investors. It is the purest definition of an asymmetric, high-risk, high-reward setup.
Which brings us to the final verdict today. If you're looking at SATL, the analysis clearly frames this as a long-term, multi-year view. It's not a technical swing trade where you jump in on a Tuesday hoping for a quick 10% pop by Friday.
No, not at all. The investment thesis here demands extreme patience and a high tolerance for volatility. You're looking at a company trading at 68% off its highs, which offers a heavily discounted entry point into a booming geospatial market. But that thesis only survives if their AI partnerships can accelerate top-line revenue fast enough to finally outpace the massive fixed costs of space infrastructure.
They have the orbital hardware, they've built the AI architecture, and frankly, the unfortunate macro environment of global conflict has handed them a multi-year tailwind of defense spending. The only question left is whether their balance sheet can survive long enough to capitalize on it.
I think that captures the financial reality perfectly.
But as we wrap up today, there is a lingering thought that goes far beyond stock valuations or profit margins. As companies like Satellogic succeed, and they are succeeding in blanketing low Earth orbit with high-resolution sensors paired with AI that never sleeps, humanity is crossing a threshold into a true era of persistent global intelligence.
The societal shift there is just profound.
Right. Think about the evolution of GPS. 30 years ago, satellite navigation was a highly classified military tool. Today, the technology is so utterly commoditized that it's tracking your food delivery in real time, and you don't even give it a second thought.
Yeah, we take it for granted.
So if persistent global intelligence, this real-time, AI-interpreted video feed of the Earth, follows the exact same trajectory and becomes as ubiquitous and commoditized as GPS, what happens to the concept of privacy on this planet?
It's the defining technological question of the next decade, honestly.
When the map is no longer a static picture, but a live feed, who holds the ultimate power? Is it the billionaires launching the hardware into the sky? Or is it the AI algorithms deciding how to interpret our every move? Because when the map is moving constantly, the concept of a blind spot disappears entirely.
And when the blind spots disappear, there is nowhere left to hide.
Something to think about. Remember, you can check out the VIP Algos link below in the description to stay on top of market signals. Please subscribe, like, and comment if you enjoy the show. Keep questioning the consensus, and we'll catch you next time.